An SMSF is a self-managed super fund. With an SMSF, you basically have more control about what's happening with your investments. You're making the decisions rather than giving it to someone else to make a decision. Whether they're going to make a good or bad decision, you don't know. They just go with the market.
You've got buyer's agents out there, you've got mortgage brokers out there that don't even do it themselves. I know so many buyer's agents that don't even have property themselves. I know mortgage brokers that don't even have a home loan themselves, but they want to advise on selling property. They want to advise on giving out loans.
You want people that are giving you advice, that are your professional points of contact, to actually be in the game.
Yeah.
Like you want to talk to a mortgage broker that has mortgages. You want to talk to a buyer's agent that owns properties. You know? So I think finding the right type of professional to help you goes a long way. And also not always going for the cheapest.
Yep.
You know, I've fallen into this trap myself, especially when I was a bit younger. You always look for the best deal. I think it's about finding the right accountant, lawyer, mortgage broker, buyer's agent, all of that stuff. Have your go-to people and then just continue to use them and build those relationships.
Hi everyone, and thanks for joining me in another episode of The Mortgage Chat. Today I have a very special guest in the name of Andrew Romano from FTC, who will be talking all things about SMSF today. Welcome to the show, Andrew.
Good morning, Tony. Glad to be here.
Now, just for our audience to know, can you tell us a bit about yourself and what you do?
Sure. So my name is Andrew. I am the director at FTC. We are a finance, accounting, tax advisory firm specialising to property investors and small businesses. So we try and help our clients build wealth with better tax planning and structuring.
Okay, so Andrew, I brought you in because, we've had a lot more inquiry and conversations about self-managed super fund.
Yes.
And you're a specialist in that field. Okay?
Yes. Yep.
So can you explain to me, how, when, and why someone would consider doing an SMSF?
Okay. Well, an SMSF is a self-managed super fund. So at the moment, your employer would be putting about 10 or 11% of your total salary into a super fund, which is managed most likely by an industry super fund. So what they generally do is they will get that money that they get from the employer and they will invest that over your lifetime. That also causes a lot of restraints because you don't really have control on what you can invest in, how you can invest it. So this is where SMSFs come into it.
Yep.
So with an SMSF, you basically have more control about what's happening with your investments. You're making the decisions rather than giving it to someone else to make a decision. Whether they're going to make a good or bad decision, you don't know. They just go with the market.
So someone that's heavy in the stock market is perfect for it. Is that what you say?
I think, to be honest, it just depends how involved you want to get in your retirement planning. Because it's a good vehicle to invest because the government gives a lot of tax breaks to super funds.
Yep.
Because the idea is the government is trying to phase out pensions. So I think anyone that's over about the age of, I think 50, under the age of about 55-ish, I think, they're not going to get the pension.
Yeah.
So the super fund is there to replace that income stream when they get to retirement.
Yeah. But you wouldn't open an SMSF if you don't know nothing about investments, would you? Or you're not a heavy investor yourself, regardless if it's property, stocks, bonds?
100%. If you don't know what you're doing, then just leave the investing to the super fund, to the industry super funds, rather than doing it yourself, because it also works both ways. So if you do a few bad investments and you lose your super fund, then what are you going to retire on?
Exactly.
So it's always best. If you don't know what to do, leave it to the professional body to sort that out for you.
And when did you start your business, Andrew, as an accountant?
So I've been in accounting and tax for about 15 years.
Yep.
Working for large corporates, doing a lot of their advisory stuff, especially with international transfer pricing. That's where it all sort of began. Then I went off on my own in probably about 2016, 17. And then rather than catering to the corporates and the big business, I now look after small business and focusing on property investors as well.
So have you seen more SMSF more common these days?
It's definitely a trend at the moment with more and more people wanting to take control of their investments, especially what happened after the GFC in 2008. You've had a lot of people that don't trust the system and think they can do better. And they may not, we don't know. But it's always, if you have enough knowledge to do it yourself, it always makes sense because it works out cheaper for yourself.
Okay.
And then you have more control of what you're doing.
What do you mean by cheaper, but?
Because your super fund would be charging you fees each year just to keep the super fund open.
So you're talking about, me investing in like HESTA or Australian Super, yeah?
Exactly. Okay. So the Hesters, the Rests, the Aware Supers, they would charge you a fee each year, regardless whether you make money or not. Then they'll also have like a performance charge. So as the super fund goes up in value, they also charge you fees, even though they haven't actually finalised those gains.
Right.
So if your super fund is at 100K and at the end of the year it's worth 120, even though they don't sell, then they still make a gain for a fixed fee to keep the super fund open to charge you, and then they'll make a gain on the gap.
Right, okay, fair enough.
They hit it a couple of times.
Yeah, okay. So is purchasing property under SMSF more common as of late?
Yes, so I think personally from what I can see, I see a lot of people transitioning to that, and there's two main factors. One factor is you have people that want to buy property and aren't able to buy property in their personal names.
Yep.
And that's probably the most prevalent, and that's why they go to super funds.
Yep.
The other is they can't buy property in their personal names because they haven't got the borrowing capacity.
Yep.
Then they go to their super fund.
So if you buy a property under your SMSF, are you allowed to live in the property?
100% not.
Okay.
No. If you do that, you will get caught, and the ATO of the government will come down hard on you, because the SMSF vehicle is not designed for you to buy property, for you to live in.
Right.
It's purely for an investment purpose, for you to fund your retirement when you retire.
Yep. Okay. Quick question here. Now, we have a lot of inquiries about SMSF purchases. Okay. Are you allowed to buy vacant land under your SMSF?
So this is a very tricky question, because it comes down to the super fund needs to generate money.
Correct. From day one, right? When you buy the asset, does it have to generate income from day one?
Not necessarily. So this is where it becomes it's a case-by-case basis, because, for example, in your SMSF, you can buy gold.
Yep.
You can buy precious metals. That generally doesn't generate an income. It just sits there, and you're assuming or you're hoping that the value of that gold is worth more when you sell it. So with land, it's a bit different. You have to have the intention of actually making it an income-producing asset.
Right.
Because otherwise, you may have all this land. It could have went up, it could have went down. You don't know. But then by the time you get to retirement, it's not generating any income. So how is it going to fund your retirement?
Yep. So it's the intent. So you're saying the intent to build on it if you buy a vacant land?
Yes, I think it's the intent to build on it. But you can't say, I'm going to buy a block of land today to build in it in 30 years.
Yep.
I don't think it works like that.
Yep.
It's more so, I'm going to buy a block of land in Kellyville for that to get built in 6 months. That, there's a direct nexus, there's a direct connection, that there's going to be an income generating asset. That's when, more likely than not, you can put it to your super fund.
So now let's talk about the assets held in the SMSF. Okay. All right. So should there be a mixture of property, stocks, bonds, TDs? When I mean TDs, I mean term deposits. Should there be a mixture of assets held within the SMSF? Is there a ruling? So what I'm saying, is there a ruling to that?
Look, because it's an SMSF, you can choose to invest whichever way that you like, based on the strategy that you think will work for yourself. But generally speaking, you always should have a balanced portfolio, because you never know. At the moment, property is doing pretty well. Property is doing well and doing bad at the same time. You don't want to be too invested in one asset class. You want to have spread. So you want to spread your risk across multiple classes.
Yep.
You could be highly levered in one specific area if you want, but it's always advisable to have a mixture of liquid and illiquid assets.
Right. And who normally advises on that? Is there a professional that can advise on what sort of asset allocations you should have on the SMSF?
100%. You can go to a financial planner, and the financial planner will give you financial advice. But just remember, if you're going down the path of SMSF, you're more likely than not really wanting to get the advice from them and doing it yourself. So that's the trade-off. If you're going to go do an SMSF and get advice anyway, then you're not really self-managing. You're going to someone to give you advice to how to manage it, which is still good and bad, but it's a personal preference.
Yeah, fair enough. So with SMSF, what are the pros and cons of setting up an SMSF?
So I think the first, let's talk about the pros. So I think the pros is it's a flat rate of 15% tax on income that's generated, net income. The government at the moment is playing with that, so it could change. But at the moment, and the way it's been for the last so many years since the inception of SMSF, it's 15%. So that's always a big positive because the tax rate is flat and it's relatively cheap.
Yep.
I think the second positive is the loans that are associated with the SMSF don't actually impact your personal borrowing capacity.
Yep.
Because it's a separate investment vehicle. So that always helps as well. And I think the third positive is you have control. You have full control on what you want to do. If you want to leave all your cash in a term deposit forever, you can.
Yep.
You know, if that's going to suffice for your retirement planning. If you want to put a bit here, a bit here, a bit there, you can also have that option. So I think the flexibility is what really makes an SMSF that vehicle that everyone wants to use. In terms of the negatives, I think the negatives, the main negative for me, from a personal opinion, is you can't really utilize those gains until you retire. You know, are you going to make it to retirement age? We don't know. You're going to get there. That's probably the biggest negative is any investments that you make a gain from, you'll get the gain, it'll be taxed, but has to stay within the super fund until you retire.
Right. So let me ask you a question in relation to tax deductions within an SMSF. Okay. Now, because an SMSF is an entity in itself, right? So let me give you an example. Let's say I hold a property within an SMSF and that property is neutrally geared. Okay. So it's not costing me an extra cent to maintain the property. My contributions from my employer can maintain it. Okay. Yeah. Okay. And let's say, for example, I have $5,000 in depreciation claimables for that particular house that I can claim back for that financial year. Because my property is neutrally geared, essentially, what happens to that $5,000 depreciation right there? Can I transfer that out to the beneficiaries within that SMSF?
Unfortunately not. So I think when it comes to property, it's an investment class that's 20, 30 years. So this is where there's a lot of negativity in the media around negative gearing. So negative gearing, it is a form, it's basically a strategy that's implemented by the government to allow people to offset any losses against their personal income tax. So negative gearing usually lasts generally about 10, 15 years, but eventually that property will turn positive. It becomes positively geared. So then those people that have those investments are actually adding to the tax base. So they will start paying tax. But the thing is, governments are only in power for 3 or 4 years. So they only focus on the beginning. And it's always going to be a cost to the government by negative gearing. In terms of an SMSF, negative gearing is still there, but those losses actually don't get pushed down to the beneficiaries. They stay with the super fund up until that turning point, which is about year 10, year 15, depending on the property, location, all that stuff. Eventually, that property will turn positive, and then those gains will get offset those losses.
Right, I got you now. Okay, so let's say, for example, for the first 10 years, I had a claimable of 20 grand, for example, but I can't claim that back because the property was neutrally geared. But however, once that property becomes positive geared, let's say, for example, it went positive geared for, let's call it $1,000 for that financial year, I can slowly eat away from that negative gear claimable.
Exactly.
Yeah.
Exactly. So it will sit on the super fund's balance sheet. And eventually it'll get eaten. And once those losses all get eaten, then the property becomes positive and the super fund will start paying tax on those gains.
Right. Mate, that's a big nugget right there because I don't think a lot of people understand that.
That's the thing when you're buying property within a super fund and without. If you're a high income earner and you have negative losses from a property, those losses or negative gearing losses, those losses get offset against your taxable income. So all of a sudden now you're getting tax back from the government throughout your working life. Whereas when it goes into the super fund will still get those benefits, but over the term of the super fund. So you won't be able to offset those losses against your personal income tax rate.
So let's talk about contributions, right? So let's say I'm on 100,000. Based on current superannuation employee contributions is 10.5%.
I think it's 10.5, 11%.
Yeah, something like that. Okay. So how much can I personally contribute extra into my super fund at that 15% tax rate?
So the way that it works is and this is where it starts to become complex. You got different contribution limits, but generally speaking, you can put up to $27,500 worth of contributions to your super fund per year to get taxed at that 15%.
Is that 27,000
500.
my own pocket, or is it together with my employee contribution?
It's together with your employer contributions.
Okay.
So if your employer puts in 10, you can put in an extra 17 and a half. And what you can do, you can also salary sacrifice that 17 and a half. So you could lower your taxable income by 17 and a half grand for that money to go into the super fund.
And that'll be perfect for someone that's on a very high tax bracket, right? So let's say, for example, I'm on 200 grand. I'm at the highest tax bracket, right? Because at 200 grand, for the last 20 grand, I'm taxed at 47%. Is that correct?
Well, if you're a high income earner, you can only put 27,500.
Yep.
If your employer's already putting 11%, say, then you can only put another 5.
Yep.
To
Correct.
make it to the 27.
Correct. Right. So yeah, instead of paying, that 47% tax on 5 grand, I can essentially, I can shift that extra 5 grand into my SMSF, and I can pay 15% tax only.
That's correct. And you could also increase your borrowing capacity within your super fund because the contributions are maxed at 27,500. You have a better loan serviceability ratio, so you can get more money from a broker or a banker as well.
So Andrew, when would someone want to set up an SMSF? Is there like a minimum balance that's required when setting up an SMSF?
So I get this question all the time. There is no minimum balance.
No minimum balance?
There's no minimum balance. But obviously, there is a cost to set up the super fund. Then you also have a cost to maintain the super fund. If you only have 20 grand in your super fund,
Yep.
And it costs you X amount of dollars to set up, all of a sudden that's gone. Then you've got the yearly compliance as well because you need to pay an accountant, an external auditor to do all of that stuff. If all of a sudden now a lot of your fees are getting eaten up by compliance costs, then it generally doesn't make sense.
So these fees come out of your super fund? Is that what it is?
Yeah. So the super fund will pay fees out of the super balance.
Right.
Yep.
Okay. Now, when you're saying yearly audits, are you talking about tax returns or financial statements and all that? Is that what you're referring to?
Exactly right. So each year you'll need to do a tax return.
On top of your individual tax returns, you have to do tax returns for your SMSF, correct?
That's correct. So because it's a completely separate entity, it will need to have its own set of financial statements, its own set of tax returns. And on top of that, it will also need to get audited by an external auditor. That's not the accountant or tax agent that's preparing all those documents. So it has to go to an external party for them to audit. And then once they audit it, then it gets lodged to the government, to the ATO, if there's no issues with the audit. If there's issues, then if there's any compliance issues, then it doesn't get passed, and then that causes another problem with the ATO.
So let's say I'm at retirement. I have an SMSF and I'm at retirement age. Okay, and all my assets held within that SMSF has no debt. Okay, let's say I have property in there, stocks, term deposits, whatever you want to call it. Okay, so at retirement age, I can gain access to it. I can sell it off, whatever I want to do with it. All right. Now, let's say in the event that I do pass away, what actually happens to that SMSF?
So it's a very complex issue and something that I can only give you very general advice on what happens. So generally speaking, they refer to the trust deed, the SMSF deed, which is a document that specifies who gets what, how it all happens, how it gets pushed out. But generally speaking, if you pass away and there's an SMSF balance and their dependents, so under the age of 18 up until 25, depending on different rules, that money comes out tax-free. Right, for those dependents. If there is no dependents and everyone is over the age of 18 to 25, then there's a different process where they work out the tax that needs to get paid, and that's where the tax will need to get paid on the distribution.
So you're telling me that the assets within the SMSF has to be distributed into the beneficiaries? The beneficiaries cannot take over the SMSF?
So it just depends on the SMSF deed. It just depends how it's set up. But usually it doesn't happen like that. Usually everything gets sold off and then it gets pushed out to the beneficiaries. That's what generally happens. But it could also change because, if there's multiple members, for example, husband and wife, maybe instead of going from the husband, if the husband passes away, it may all go to the wife first. There's all these different types of scenarios that can happen.
So setting up an SMSF, you have to pretty much have an accountant, a financial planner. Would you say a financial planner is needed? No,
so all you need to set up an SMSF is an accountant. And you can go to an accountant, you can go to a financial planner. It just depends who you want to go to. The financial advice piece, that can only be done by a financial planner. The tax returns can obviously be done by a tax agent, accountant. And then the audit will need to be done by an external auditor.
Okay.
So
Now, is there a solicitor that needs to be involved as well?
not necessarily, not anymore.
Not anymore.
Not anymore. So
Okay.
now you can actually go to an accountant and they can set up the SMSF for you.
Yep.
Of course, they can advise you on where to put things, how to put things, all that sort of stuff. The actual structure and the setup can be done by an accountant or tax agent.
So can having an SMSF be costly?
Yes or no. If you put money directly, if you roll, so say you set up a super fund, you roll over your super balance from your industry super fund into your SMSF, and there's a balance there that's just accumulating interest, for example, it may work out to be more costly for you to have that fund open if you're doing nothing with it. But I think the value is the fact that you can do whatever you want, and there's no dollar figure on that.
Yeah.
So if you have an SMSF with 100 grand cash in it, yes, you're going to have compliance fees to keep it open, to maintain it, all that sort of stuff. But you have 100 grand for you to invest the way that you want to invest it.
Yeah.
So I think that's that hidden value that no one sees.
Yeah. Okay. So the cost that's setting up. So the cost of a super fund essentially is broken down to the setup costs and the yearly auditing, accounting, or that maintenance costs.
100%. So setup fee, the setup, the establishment of the SMSF, and the compliance. So two separate buckets. So the compliance will need to get done every year.
So, Andrew, now under SMSF, and people are buying more properties under SMSF these days. Like you said, they can control what they invest in. Okay. And we've seen a lot of properties being purchased under SMSF or trust, but let's go about SMSF right now. Should a consumer buy positive geared properties under the SMSF so they can pay down that debt faster? Or they should be chasing the more capital growth properties?
Okay, so this question, I'm just going to say it, not financial advice. I'm just saying it very, very generally speaking. So usually with properties, especially if you're looking for the retirement age, it just depends where you are on that scale. If you're closer to retire, it definitely makes sense to have properties that are more positively geared because you want that cash flow coming in. Whereas if you're a bit younger and you're not going to need that retirement money until well down the track, then you can be a bit more risky. That's where you can buy more expensive properties with more negative gearing because you're going to have time to start eating away at those negative losses before you get to retirement.
Yep.
So, it's a very open question. It just depends where you are on your life cycle.
Okay. Andrew, what are the ways an employee or even a business owner can contribute more into the super fund to increase the balance for investment purposes? So
if you're a PAYG employee, there's not many ways to reduce your tax, to be very honest. But there are a few things that you can do. And I think with SMSF specifically, you have more control over your retirement. So it makes sense to salary sacrifice more into super if you're doing your SMSF. It does also work if you're with an industry super fund as well. But again, it goes back down to you having the control. If you are looking to buy a property within your SMSF and you have the contribution cap, which resets every year. If you want to buy property, it may make sense for you to salary sacrifice more into it. You'll get the tax savings as a tax deduction on your personal return, or then go into a super fund. You have more cash in your super fund with the higher borrowing capacity as well to actually acquire more properties. You may make the decision to salary sacrifice your normal PAYG income into a super fund, into your SMSF, and that's where you can then go, well, I want to put some into shares. I want to put some into gold. I want to put some into equities. So now you have that additional money come into your super fund that you can start using as you please.
Okay. Are you allowed to have multiple properties within an SMSF?
Well, there's no limit to how many properties you can own. It goes back down to your borrowing capacity as well. So it just depends how much the banks or the brokers want to lend to you to purchase property.
Okay.
If you have a 40 grand limit and you want to go buy 20 properties, it's probably not going to work. But again, it's a very long-term strategy. So if you're looking to buy property, especially multiple properties, the intention is most likely not to sell them, is to use them to retire with.
So being a SMSF specialist yourself, what sort of strategies have you seen your clients do with this SMSF?
So I have people that like to go the balanced approach because SMSF is also not a game. I've known people, not clients, that have gone down the path of SMSF and they play the stock market and they lose a lot of money.
Yep.
So I think if you're going to go down that path of that type of wealth creation strategy, you could call it, probably stay away from SMSF.
Okay.
Because you have a lot of control with the money that you have within the fund, and it needs to be long term. You
Yep.
need to be looking at 10, 15, 30-year life cycles before you start making investment decisions, because that's going to fund your retirement. That's going to pay for you to retire from 70 to until you go. So you want to make sure there's enough money there to last.
So what happens, let's say, for example, I'll purchase a property under SMSF, okay, and, by the time I'm retired, I sell it. Are there gains that's paid for that property when I sell it?
Yeah, so with property, like any property owned in any structure, whether it's a company, personal, or whatever, there is still tax that needs to be paid.
Okay.
It's obviously taxed at a lower rate because it's an SMSF. However, it also depends on your age when you pull it out. So the way that it's taxed, it's all dependent on your retirement age.
Right, okay. So let's say, I know, just give me a ballpark figure. Okay, let's say, what's the tax bracket would be if I'm 65 and I sell a property, I make gains of 500 grand, for example, under an SMSF and under just a normal individual?
Well, if you owned a property in your personal name and you sold it, you kept it for more than 12 months, the gain would be divided by 2.
Yep.
So say you got 500 grand gain, you firstly divide that by 2, it'd be 250.
Yep.
And then you'd pay your normal marginal tax rate.
So that extra 250 gets added onto your existing personal income for that year, and that gets taxed at that bracket.
Exactly.
Yeah?
And then they'll calculate the tax based on your total taxable income.
Yep.
Whereas with an SMSF, say you had the same gain of 500,000. So what would happen is you'd get a discount of a third.
You get a discount of a third.
So whereas PAYG, if you keep it, you get 50% discount.
Yep.
Get a discount of a third. And then that will then be assessable at the SMSF rate, which is 15%.
Okay. Right. So once I sell it and I liquidate it in cash, and that's pretty much my retirement fund, right?
Exactly. Exactly. So at the moment, what happens with retirement, with the age, if you reach the certain limit, you're allowed to take lump sum cash out, you're allowed to do income streams. The thing is, for us to talk about it today, it's too far ahead. The rules may change. So it's it's very client specific, because what's happening to someone now at 70 may change by the time I get there.
Yeah. Mate, so essentially, if you started buying properties under your SMSF back in 2000, let's call it 15, because 2015 till now, we probably had about 3 booms. Mate, you probably would have made bank on your SMSF, wouldn't you?
SMSF or even personally, you'd be making bank regardless.
I know, right?
Like after what happened with COVID, like there was a big boom, the cycle really went up.
I know.
And anyone that owns property anyway basically made money.
Now, are you personally doing anything under do you have an SMSF set up yourself?
Yes, I look after my own SMSF. I look after all my own stuff. I don't like relying on other industry super funds or anything like that. I do everything myself.
Fantastic. So Andrew, I know personally you're doing, you're a buyer's agent on the side, but you only do that for your existing customers. You don't really market yourself as a buyer's agent. Okay, so what are you doing personally for your accounting clients in the buyer's agent world?
So I've been in property from a very young age. So I've seen the cycles up, down, managing properties in terms of tenants, me as the landlord. So I've seen the cycles and I understand the process pretty well. So what I like to do is offer my services to my clients, because it's one thing to see someone that tells you to do this, this, and this, but then doesn't do it themselves.
Exactly.
So I like to tell people, and I tell them what I've done. What I've done, this is the way that I've done it. This is who I speak to. And I think that also really helps the personal relationship with the client as well. Because I've seen on, I'm sure everyone sees it on their Facebook, their Instagrams. I always see these people pop up. They're like, we bought this property. It was $475 on market. We got it for $420 because of our relationships. Instant equity gain of $55,000. That doesn't happen.
Burns you?
Does
it burn you?
Well,
we see that?
It does burn me a bit, but I think it also burns the people that actually do it. Because if I have a property or you have a property that's worth $475, you're not going to sell it for $420. Especially when you're talking about hundreds of thousands of dollars. So people just need to be really wary of, these get-rich-quick schemes.
Yep.
Property is a long-term investment. If you're not looking at it from a 10, 15, 30-year life cycle, then it's probably not the asset class that you should be looking at.
Yeah. And I like that, right? Because, you got buyer's agents out there, you got mortgage brokers out there that don't even do it themselves. I know so many buyer's agents that don't even have property themselves.
Yeah.
I know mortgage brokers that don't even have a home loan themselves, but they want to advise on selling property. They want to advise on giving out loans, right? How does that make sense to me sometimes? I don't know.
100%. You want people that are giving you advice, that are your professional points of contact, to actually be in the game.
Yeah.
Like you want to talk to a mortgage broker that has mortgages. You want to talk to a buyer's agent that owns properties. So I think finding the right type of professional to help you goes a long way. And also not always going for the cheapest.
Yep.
I've fallen into this trap myself, especially when I was a bit younger. You always look for the best deal. You go for the cheapest. But the cheapest doesn't necessarily mean the best output for you. Because what happens is the person that's running really cheap, they're running really cheap, not just for you, but for everyone else. So what happens is they're looking at it from a volume game.
Yep.
So they'll get multiple people.
And there's plenty out there, right?
There's plenty out there. It's a race to the bottom. So I think it's about finding the right accountant, lawyer, mortgage broker, buyer's agent, all of that stuff. Have your go-to people and then just continue to use them and build those relationships.
Yeah, 100%. Andrew, thanks for joining me on the show today, and thanks for giving us such insight information about self-managed super fund. So just our audience can find you. Can you tell us where they can find your details?
100%. So obviously I have an Instagram page, Facebook and Twitter. Very vocal on Twitter. So for anyone that wants to follow me, so it's my handle is real Andy Romano on Twitter. For Instagram, it's andrewromano.ftcau, and Facebook will be that one as well. So hit me up, follow me. If you have any questions, feel free to reach out to me. I'm sure Tony will put my details at the bottom. So
maybe.
let me know.
Thanks, Andrew.
Thank you.
And thanks for joining me on another podcast, and we'll see you next time.